Welcome to this explainer. Today, we're going to be treating the economy like a giant, super complex machine, and we're going to explore exactly how governments can go in and upgrade that machine's total productive capacity. If you've ever wondered how countries actually build real, lasting wealth over decades, rather than just panicking and reacting to short-term crises, well, you are definitely in the right place.
So let's jump right in with a massive question. How do you expand an entire nation's economic output without just causing rampant inflation? It's a really delicate balancing act. If you just print a ton of money or encourage everyone to go out and spend more, prices are just going to shoot up. To get true, sustainable growth, you literally have to fundamentally change what the country is capable of producing.
To answer how they do that, we've got a really clear roadmap today: defining supply-side policies, visualizing economic growth, opening up the policy toolbox, hitting those big macroeconomic objectives, weighing the strengths and weaknesses, and wrapping it all up with a crucial exam tip.
Okay, part one, defining supply-side policies. Let's start with the what and lay a really strong foundation here. The absolutely crucial takeaway is that these strategies are entirely focused on expanding the long-term capacity of our economic machine. We're not just tweaking short-term demand here. Governments achieve this by zooming in on the factors of production. So that's land, labor, capital, and enterprise. Basically the core ingredients of the economy. If a government can increase either the raw quantity of those factors or just make them higher quality and more efficient, the whole entire economy can suddenly produce more.
Moving right along to part two, visualizing economic growth.
To make this abstract idea a bit more concrete, think about a production possibility curve, or a PPC. When there is an outward shift, like moving from an initial curve A all the way out to curve B, that represents an increase in total supply. Conversely, an inward shift would mean economic decline. But that outward shift, that tells us the economy is now physically capable of producing more consumer goods and more capital goods, using all of its available resources. The actual boundaries of what's possible have expanded.
All right, part three, the policy toolbox. Let's crack open the government's economic toolkit and see exactly what levers they're pulling to make this happen.
First up, governments can invest heavily in human capital. We're talking spending big on education, retraining schemes, and healthcare. Think of it like a massive software upgrade for the workforce. It raises both the quality and the productivity of the people doing the work. Then we have labor market reforms. By taking steps like decreasing trade union power or lowering minimum wages, the actual cost of production for firms drops. And theoretically, those cheaper labor costs encourage businesses to go out and hire more workers, which expands total output.
Next in the toolkit, we've got financial and regulatory levers. By slashing direct taxes, like your income tax or a company's corporation tax, governments aim to incentivize people to work harder because, well, you get to keep more of your own money. It also leaves firms with extra cash to invest in new machinery. Right alongside this is deregulation. This is essentially stripping away government controls and red tape. Getting rid of those rules decreases compliance costs for businesses and creates a much more competitive, fast-moving market.
Finally, governments can completely alter social incentives. For example, restructuring unemployment benefits can strongly incentivize folks who are out of work to actively go and seek employment, which boosts the active labor supply. And we can't forget privatization. This means taking massive state-owned monopolies, which are often so big that private companies just can't compete, and selling them off. Opening them up injects private sector efficiency and ultimately bumps up the total supply in the economy.
Section 4, hitting macroeconomic objectives. So we know the tools, but why bother with all these complex, sometimes painful adjustments?
Well, because expanding supply acts as a long-term cure for economic stagnation. It actually hits several major macroeconomic targets all at once. First, potential national output increases, giving us higher real GDP. Second, it brilliantly tackles inflation. All that greater supply actually puts downward pressure on prices. Third, unemployment falls because, hey, producing all this extra stuff requires hiring more workers. Fourth, the current account improves, as those lower domestic prices make a country's exports way more attractive globally. But, as our sources point out, it's not a perfect system. These policies can really negatively impact income distribution, often worsening inequality since wages might drop due to those labor market reforms we talked about.
Which brings us perfectly to part 5, strengths and weaknesses. Like any major engine overhaul, there are side effects we need to look at impartially.
Let's weigh this up. Supply-side policies are absolutely fantastic for long-term growth, stability, and international competitiveness. But we have to acknowledge the severe drawbacks here. First, they are just incredibly expensive to implement. Second, the time lags are massive. Building a school or retraining an entire workforce takes years before the economy feels the benefits. And because it takes so long, these plans are super vulnerable to political changes. A new government can just swoop in and scrap the whole thing. We already mentioned the worsening of income distribution, but finally, there's a serious risk of cronyism. When privatizing state assets, sometimes preferred bidders end up snagging them at knockdown prices, which isn't great for anyone else.
Finally, Part 6, the exam tip. Before we wrap up, I want to clear up a vital point that constantly trips people up.
It's the tricky difference between fiscal policy and supply-side policy. A lot of measures can actually be both, depending entirely on how you look at them. Think about a government building a new school. The immediate spending of cash to construct that building, that's fiscal policy, because it injects money to boost total demand right now. But the long-term result, creating a more educated, highly productive workforce, that is a supply-side measure. So the golden rule here is to always look at the ultimate intention. Are they trying to boost immediate demand or expand long-term total supply? Keep that distinction locked in your mind.
So I'll leave you with this final thought to chew on. When we are dealing with the actual health of a nation's economy, is the painful, long-term cure of supply-side economics really always worth the side effects? It's a huge question that every government has to grapple with as they look to the future. Thanks for joining me for this explainer, and keep exploring the incredible mechanics of our global economy.